We grew our revenue by 38% in this period compared to last year. There are two broad components of our revenue: net interest income, which grew by 44%, and non-interest revenue, which is your fees, which is your trading revenue, that grew by 30% in this period. That net interest income is largely driven by three broad factors. The first is balance sheet growth, and I'll show you that in a subsequent slide. We've seen growth in our customer assets, we've seen growth in our customer liabilities, and as a result of that, that gives you growth in revenue. The second piece to that is rising interest rates, which is what technically they would call endowment effect. We've continued to see in this rising interest rate environment our interest income increase. The third piece to that is managing our cost of funding, which is a journey that we've spoken to before. So we've been very keen on how we manage our cost of funding, and the ratio that is just on the right of that, which is net interest margin or NIMS, speaks to that. We've grown that by 122 basis points. What is that about? It's rising interest rates, but also, which is really the costs and the pricing of our facilities, but on the other side, carefully managing how we fund our liabilities and our pool of resources to ensure that we can extract return. On the operating side of things, we managed to reduce our cost-to-income ratio by 663 basis points to 41.6%. Again, this is a number that we have consistently worked on. If I can take you through a journey over the last 3 years, 4 years really, this cost-to-income ratio was in the mid-50s. In 2021, we brought it to just over 50%. Last year, we brought it to 48%. It's now 41.6%. And we continue to work on that journey. And what does that exactly mean? It's balancing our need to invest, but also extracting maximum value from the investments that we've made. That is a ratio between cost to revenue. If you look at our revenue up 38% and our costs up 19%, you see that we're extracting efficiencies and we're extracting value from the investments that we're making. Allow me to skip to the bottom left corner ratio, which is the credit loss ratio and feeds into the income statement. That is the impairment that we take on credit facilities that we've given out there. That has gone up about 100 basis points to 2.18% and this is really reflective of an overly heightened credit risk environment. But particularly for us, it's really looking and eyeballing our customers and some of those that face challenges as we work to resolve the challenges that they have, taking the impairment that is required. If I just broaden the 2022 picture so that it's not outsized, in the whole of 2022, our CLR was 2.21. So the 2.18 is really within the ballpark, and it's, if you think about the macro environment that we've operated in, it's there, it's in that scheme, the broader scheme of things, that CLR is within what we would expect in this environment. That gives us a profit after tax of 7.1 billion, which is 47% up year on year. ROE following through to 20.5%, and Dr. spoke to that, 475 bips up year on year, and followed closely by EPS, which is kind of follows through that. And the dividend has been spoken to. So really, if I just reflect on the income statement, growth in the income, in the revenue generation, growth but measured in our cost of operations, appreciating the cost of risk, which is in a CLR, and that giving us a profit growth. This is the income statement in the way we like to see it, but it's exactly what I've spoken to. So allow me to skip this and talk about the balance sheet. So some highlights of the balance sheet. So Our balance sheet, total assets grew by 13% this period to 384 billion shillings. And it's important to see the parity between that and the customer franchises. So our customer loans grew by 12%, our customer deposits grew by 10%. The environment that we have operated in has called for us to be very measured in how we grow our balance sheet, but also optimize the efficiency of the balance sheet. If I reflect on the industry in Q1, which is the published results that we have, industry grew by about 11% in total assets. In customer assets grew by about 10%. Deposits grew by about 8 or 9%. So it's above industry, but we're keeping pace with the industry, just slightly above industry, and continuing to grow the key fundamentals. There's a ratio that we like to track within the bank to say how much of our resources, how much of our balance sheet are we deploying to customer franchises. And that is a number that we've continued to see increase. About 64% of our total assets are in customer franchises, which is exciting for us because it helps us live our purpose of growing the country. That has been coming up from mid-50s to early 60s towards the end of 2022, and now at 64%. NPL ratio at 9.23%. I must paint a picture of where the industry is. Industry NPL ratios is now just below or there about 15%. So 9.23% for us is exciting. What does that exactly say for us? It says that we are vetting the clients and the assets that we book on our balance sheet. But two, and more importantly, is when our clients hit bumps on the road in their journey to success, we work through them to resolve those, and that is how you end up with that kind of a ratio. We'd like to lower it, so there's a lot of work on a gentleman on the right of this room working through to keep on lowering that NPL ratio. We are sufficiently capitalized, and we have sufficient capital, as you can see on the bottom right, two ratios that speak to our capital and liquidity. In a different way, I would show you by this, so you can see our liquidity ratio consistent, about 36% between last year and this year, and significantly above our 20%, which is the statutory requirement, and also above our appetite. And capital adequacy for both core and total capital also within, above the statutory requirements. This is a slide that Patrick spoke to, and allow me to just open it up a little bit. I think what's exciting for us here is we are just not a bank. We are a complete financial services house. When you interact with Stanbic, you get investment opportunities, you get banking, which is your loans, your traditional deposits, transactions, payments capabilities. You also get, our customers get bank assurance or insurance intermediation, and we are doing most of that in Kenya, but in part we are doing that in South Sudan. The second leg to that message is that all these businesses are managed as one house, and therefore that is why you can see all of them are growing decently. Let me explain the 6% down in South Sudan. South Sudan is actually in absolute terms more than 70% up, but we had an operational incident sometimes in the second quarter of the year. We took a provision on it. But I'm proud to say that we've since resolved that issue, and that provision will be reversed. Actually, has been reversed in September, in July, and as a result, that all the businesses are growing positively. I'm in my second last slide, and this slide speaks to what we make of this, and what we make of this in the context of what Dr. Joshua spoke to. About our strategy. On the first pillar, where we focus on our clients and our people, the messages there are, despite what is happening in the environment, we remain focused, we continue to invest in our people so that we can serve our clients better as a complete financial services house. On the risk and conduct and operational excellence pillar, we continue to invest in forward-looking technology and data capabilities to continue serving our clients better, but also managing risk in a more efficient way as opposed to shooting in the dark. That's really what these results what we take away from these results. And on the sustainable returns pillar, we look at these results and reflect on continuing to prosper with our clients, to prosper with our staff, and prosper with the communities in which we operate. The work is not done for the year, so we still have some work to do in the second half of the year. Okay, sorry for that. The work's not done. We're going to continue to focus on 5 broad things, which we shared when we spoke about our full year results for 2022. We're going to continue to focus on growing and scaling our business, but also fully aware of the market in which we operate. We will be coming to the market with new solutions, enhancing and embedding the solutions that we have. We'll be coming to the market with more solutions, especially in the investments area. We'll be offering a wider variety of investment opportunities or investment products for our clients, because our clients are telling us, beyond bank assurance, beyond what you do in allowing us to invest in the equities and the bonds market, we want a little bit more color, we want access to international markets, and we'll be coming to the market with that. We'll also be coming to the market with a more, a better way for our customers to control their borrowing approach. Currently, most banks offer products. We offer you a mortgage, we offer you a credit card, then we offer you an unsecured facility. We're finding a different way to do that, where we give all of these things to you in one platform, and you can see, if I spend a lot on my credit card, then that reduces my ability to borrow on vehicle asset finance or something else. Why is that important? Research suggests that most clients don't set out to default. But when you offer them isolated solutions, sometimes they'll find themselves over-leveraged. And therefore, we start talking about NPLs and stuff like that. We want to avoid that by putting these things in front of our customers so that they can make informed borrowing decisions. We'll continue to focus on internal efficiencies, leveraging on digital investments and data. We'll continue to invest on our risk management capabilities. Daktari has spoken to a heightened risk environment, whether it's cybersecurity, whether it is issues to do with third-party risk management. So we'll continue to manage that. We'll continue to avail capabilities to our customers in the region. So we just don't want to serve our customers in Kenya. We want traders in Kenya to get the same experience when they go to Uganda, and we currently do that with borderless banking. So we're going to continue to do a bit more of that, and then we'll continue to be future ready. The results of today have been delivered by the capabilities we built yesterday. We're going to continue investing in capabilities so that we can deliver results tomorrow. Thank you.
Asante sana. Dennis Musau.